Imagine your retirement savings growing and growing, and then you don't owe a single penny in taxes on it. That's the magic of a Roth IRA. But is it right for you? Let's break down some amazing perks and some sneaky downsides you might be overlooking. So let's dive into the basics of a Roth IRA. First, there's no age limit on when you can contribute. As long as you have earned income, you can contribute to a Roth IRA. If you have a business and set things up properly, you can even put your minors to work and use their wages to fund a Roth IRA for them. Here's what you need to know about how much you can contribute. If you're contributing to both the Roth IRA and a traditional IRA, the IRS doesn't give you double the room. Your total IRA contribution limit stays the same and gets split between the two. If you have contributions from a SEP or a simple IRA plan, they don't count toward that limit. For 2025, your contribution cap is the lesser of $7,000 or $8,000 if you're age 50 or older, minus anything you've already put into other IRAs, or your total taxable income, again, minus any other IRA contributions. You can contribute to multiple IRAs, but that total can't go over that yearly limit. If your Roth contribution isn't enough for you and you're looking to stash away even more for retirement, then based on your income, you might be able to contribute to your employer's 401k plan at the same time. If your employer offers a 401k or you're self-employed and have a solo 401k, you can contribute up to $23,500 to your 401k in 2025 on top of your Roth IRA. If you're 50 or older, you can kick in an extra $7,500 as a catch-up. But here's where it gets exciting. Thanks to the Secure 2.0 Act, people between ages 60 and 63 can supercharge that with an $11,250 catch-up contribution. Next up, what happens if you don't hit the contribution limit or if you go over it? First, if you didn't contribute the full amount to your IRA for the year, you can't play catch-up after the tax filing deadline for that tax year. The deadline is usually around April 15th of the following year. Once that deadline passes, the window to make contributions for that tax year officially closes. Well, what if you accidentally contribute too much? The IRS calls that an excess contribution. Good news, you might be able to apply that extra amount to a later year as long as you stay under the contribution limit for the later year. But here's the catch. Until it's corrected, the IRS slaps a 6% penalty on that extra amount. Fortunately, there's a way to fix any excess. If you catch the mistake before the tax deadline, including extensions, you can withdraw the excess contribution and any earnings it made. It will be treated as though the amount was never contributed in the first place. No penalty. Even if you've already filed your taxes, you still have a second chance. If you remove the excess within 6 months of the original filing deadline, you can submit an amended return and potentially avoid that 6% penalty. A Roth IRA can be one of the smartest tools in your retirement toolbox. Why? Because you contribute with money you've already paid taxes on, so when retirement rolls around, your withdrawals are 100% tax-free. There are no surprise tax bills down the road. Once you're 59 and a half and you have held your Roth IRA for at least 5 years, you can take out money without owing a dime in taxes. That's right, no taxes on your savings or your earnings. This can be a huge advantage if you think your tax rate will go up later in life. Now, compare that to a traditional IRA, which forces you to start pulling money out at age 73 due to required minimum distributions, also called RMDs. With a Roth IRA, there's no RMD during your lifetime. That means you can let your money grow untouched for as long as you want, giving your investments more time to grow tax-free. It gets better. Since you're not forced to withdraw, a Roth IRA can also be a great tool to pass wealth to your heirs. Original account holders can keep their money in the account indefinitely, and that means your investments can keep compounding tax-free, and you can avoid selling during a stock market decline. Traditional IRAs often force withdrawals even when the market is down, which might mean selling at a loss. Roth IRAs give you the flexibility to wait things out. As a matter of fact, having money in a Roth IRA gives you even more incredibly valuable flexibility in retirement. Let's say you're collecting Social Security and want to pull some funds from your 401k or traditional IRA, and you don't want to push yourself into a higher tax bracket. What you can do is withdraw enough from your taxable accounts to stay within the current tax bracket, getting as close as you can to the top of that bracket without going over. But what if you need a little extra money? That's where your Roth IRA shines. You can dip into it without increasing your taxable income. That means more money in your pocket without causing a higher tax bill. In short, a Roth gives you the power to strategically manage your taxes in retirement. Ideally, the money you set aside for retirement stays there, quietly growing until you're ready to use it. But life happens, and when it does, a Roth IRA offers far more flexibility than a traditional IRA. If you pull money from a traditional IRA before age 59 and a half, you'll likely get hit with both income taxes and a 10% early withdrawal penalty. But a Roth IRA is more forgiving. If you've had the account for at least 5 years, generally you can withdraw any earnings tax and penalty free if you're 59 and a half or older, or you have one of the following major life events: buying your first home, up to $10,000, living with a disability, or in the event of your death, your heirs can get the funds without penalty. And here's the real benefit. You can always pull out the money you put in, but not the earnings, at any time. No taxes, no penalty. That means that if you have an emergency, your Roth IRA can step in without creating a tax disaster. Just remember, once you take the money out, you can't put it back in, and you're giving up any potential growth that money could have earned. Withdrawals happen in a specific order too. Contributions come out first, followed by converted amounts, and earnings last. So while it's best to let your Roth sit and grow, it's reassuring to know that your contributions are there if you truly need it. No strings or penalties attached. Although taking out contributions at any time is allowed, a Roth IRA is not totally without a few strings attached. Let's take a look at some important drawbacks you should know before tapping into your Roth. Here's where things get a bit tricky. There are actually 3 separate 5-year rules you need to know. 1. The general withdrawal rule for earnings. A 5-year clock starts ticking on January 1st of the year you make your first Roth IRA contribution. Once that window closes and you're at least 59 and a half, you can withdraw earnings tax and penalty free. If you're thinking about rolling over a Roth 401k to a Roth IRA, you should open your Roth IRA as soon as possible, even if you're not putting in very much money yet. Why? Because that starts the 5-year clock, and the sooner it starts ticking, the sooner you'll be able to access your earnings tax-free down the road. If you haven't hit the 5-year mark yet, you may still avoid the 10% early withdrawal penalty under certain exceptions, but you'll still owe taxes on those earnings. Please look at your screen for a list of exceptions. 2. The conversion rule. Roth conversions can be a smart move if you're looking to skip required minimum distributions and enjoy tax-free withdrawals after 5 years. So what's a Roth conversion? It's when you move money from a traditional pre-tax retirement account, like a traditional IRA or a 401k, into a Roth IRA. Yes, you'll pay taxes on the amount you convert now, but in return, all the future growth and qualified withdrawals are completely tax-free. Think of it as paying taxes on the seed so you can harvest your gains tax-free later. If you do convert money from a traditional IRA or roll over a pre-tax 401k to a Roth IRA, a separate 5-year timer starts for each conversion. That clock begins on January 1st of the tax year in which the conversion occurs. For example, if you do a conversion on October 1st, 2025, the timer for that conversion actually begins on January 1st, 2025. Withdraw those converted funds too soon, and you could be looking at a 10% penalty plus income taxes. 3. The beneficiary rule. Even after death, the 2 5-year rules that I just mentioned don't disappear. If you inherit a Roth IRA, you won't pay penalties, but to avoid taxes on earnings or on converted funds, the original account still needs to satisfy the 5-year rules. Otherwise, you could be stuck paying income tax even though the account owner is gone. When it comes to a Roth IRA, the tax advantages come later, not up front. Unlike a traditional IRA where your contributions may be tax deductible and give you an immediate tax break, a Roth IRA asks you to pay taxes now in exchange for tax-free withdrawals in retirement. With the traditional IRA, you get a little more money in your paycheck today thanks to that upfront deduction. But with the Roth, you're playing the long game. Of course, not getting a tax break up front means less take-home pay to spend or invest today. But don't forget about the Saver's Tax Credit. If you qualify, it could soften the blow of not getting a tax break up front. Overall, though, if you think your tax rate will be lower in retirement, a traditional IRA might be better than a Roth IRA. It really all depends on your total financial picture and goals. Let's talk about who can contribute to a Roth IRA and who can't. Roth IRAs have income restrictions. If you earn too much, you'll be locked out of contributing directly to a Roth IRA. Anyone can open a Roth IRA, but your ability to contribute depends on your modified adjusted gross income. How do you figure your modified adjusted gross income? It's your adjusted gross income, or AGI, plus certain deductions added back in. You'll find your AGI on line 11 of your Form 1040. Now, if your modified adjusted gross income is below the phase-out threshold, you're golden. You can contribute the full amount. But once your income starts to climb, the allowable contribution gradually phases out and eventually disappears. For 2025, you can contribute an amount to a Roth IRA if you're married filing jointly or a qualifying surviving spouse and your modified adjusted gross income is under $246,000, or you're single, head of household, or married filing separately, and you did not live with your spouse during the year, and your modified adjusted gross income is under $165,000, or if you're married filing separately and did live with your spouse during the year, your income has to be less than $10,000. If your income is in the phase-out range, you can calculate how much you're allowed to contribute by using IRS Worksheet 2-2 from IRS Publication 590-A. Let's walk through an example from the IRS website for a 2024 tax return. Imagine you're single, 45 years old, and earn $146,000 in taxable compensation in 2024. Your modified AGI is $147,000. Normally, you'd be allowed to contribute $7,000 to your Roth, but because you're in the phase-out range, your maximum contribution is $6,540. Did you know you can contribute to a Roth IRA for your spouse, even if they don't have earned income? It's possible thanks to the K. Bailey Hutchinson Spousal IRA law. Here's how it works. If you file a joint return and your spouse's taxable compensation is less than your taxable compensation, and your modified adjusted gross income is under $230,000 for 2025, you can put in up to the max amount allowed in IRA contributions for your spouse, even if you're the only one earning income. If your modified adjusted gross income is $230,000 to $240,000 in 2025, you can contribute a reduced amount. If you earn more than $240,000, you can't contribute to a Roth IRA. In 2025, if you file a joint return, your contribution is capped at the smaller of two amounts. One, $7,000 or $8,000 if you're age 50 or older, or two, the total compensation includable in gross income on your tax return minus what your spouse contributes to their traditional IRA and any Roth IRA contributions made on their behalf. I know that sounds confusing, so let's bring that to life with an example from the IRS website. You're a full-time student with no income. Your spouse earns $30,000 and contributes $7,000 to their Roth IRA. Since you file jointly, you can use your spouse's income to fund your Roth IRA. The $30,000 in compensation minus the Roth contribution of $7,000 equals $23,000 of qualified income. So as long as your modified adjusted gross income is below the limit, you can contribute the full $7,000 because it's under that $23,000 cap. Here's another example to show the effect of filing jointly versus filing separately. You and your spouse are both 53 years old and working. You earn $3,800 and your spouse earned $48,000. Even though your income is under the normal contribution limit, you can still contribute the full $8,000 to your Roth IRA because you're filing jointly and meet the spousal IRA criteria. Your spouse can also contribute $8,000 to their Roth IRA. But what if you filed separately? Your contribution would be limited to your actual earned income of $3,800. The bottom line here is filing jointly can drastically boost your IRA contribution options, especially if one spouse earns a lot less or not at all. Spousal IRAs are a great way for couples to maximize their retirement savings, even if one of you is currently out of the workforce. If you run the numbers and determine that you earn too much to contribute directly to a Roth, don't worry, you're not out of options. There's a workaround called the Backdoor Roth strategy, and while it takes a few extra steps, it's a perfectly legal way to put money into a Roth IRA, even if your income is above the limit. Please watch the video in the upper left of the screen if you want to learn more about how it works. If you are a solo business owner and want to know more about a solo 401k, please watch the video in the lower left of the screen. If you want to know more about the Saver's tax credit, please watch the video in the upper right of the screen. All the best to you.